Hello, traders. Gary Wagner here. It is 12:16 in Honolulu, 6:16 in New York on Tuesday, first day of November 2022, and this is the daily report for gold and silver. We are recording today's show just after 12 noon, meaning that this little red line here represents trading as it opened in Australia, with December gold currently fixed at $1,649.80, a net gain of 10 cents. That means that in New York trading, gold closed at $1,649.70, and that was a net gain of about $10 on the day. And the gain was directly attributable to the belief that the Fed might signal that they are about to pause with their aggressive set of interest rates that have occurred in 5 consecutive FOMC meetings. It is, though, widely expected and largely baked into current pricing that they will follow November's rate hike by another 75 basis points, meaning 4 consecutive rate hikes of 75 basis points. But our opening letter explains why we believe it's possible that the Fed might signal that they're about to pause, even though they are extremely far away from their 2% inflation target. Nonetheless, we had a respectable gain in gold, and that was accomplished without dollar strength or weakness. The dollar is up 0.02% and currently fixed at 111.44. Lastly, silver is currently trading at $19.61.5. In after hours, it is down approximately 5 cents on the day, but you can see from this daily candle, it opened at the 50-day moving average and traded well above it, having a substantial gain on the day. This first chart that we are looking at is this chart that we used yesterday, and it's really to illustrate the overall strength of the dollar and the positive correlation. It is a negative correlation, but it's at about 100%. If we look at gold at the beginning of March at its high at 2,077, and we are basing this line chart on the close, down to the double bottoms at about 621, both here and here, we can see that gold has actually declined by 22%. If we take a look at the rise in the dollar over that equal period, we can see that the dollar index has been in a fairly strong uptrend, actually gaining about 19%, which means by simple math we can deduce that 3% of the decline in gold was due to selling, but the vast, overwhelming majority of the decline recently in gold is definitely related to dollar strength. But I do believe that it is possible that we will have seen a bottom if, in fact, the Federal Reserve hints, alludes, or announces that they will begin to pause the rate at which they have been raising rates, or give some sort of indication as to when next year they'll begin to pivot to start to reduce it. Because as we talk about in the opening letter, the key right now is that it is costing the Federal Reserve an enormous amount of money to service the debt instruments on their balance sheet, which are mostly mortgage-backed securities, as well as U.S. debt instruments, as those yields have grown tremendously. And we'll talk about that on tomorrow's show. It is highly likely that we will send out a trade alert recommending the initiation of a long position in December gold. It would be based upon a major pivot by the Federal Reserve to either begin to reduce the magnitude of the rate hikes or announce a point in which they are looking to not only scale that back, but to reduce them. And if that's the case and we go long, we need to have an idea of our upside targets, what is realistic, and where we think it could go. Based upon that, I put up a daily chart. It has 2 basic Fibonacci studies. The first study is a basic fib retracement. It begins at the record high this year, 2,079, and then it concludes at the double bottom at 1621. The different marks to pay attention to are the 23.6% fib retracement, and that corresponds to this peak or top right here. Following that is the 38.2% fib retracement, and again, that corresponds with this low here where we saw it act as support, as well as very, very loosely this top that comes in at around $1,821. I have also created a basic Fibonacci extension so we could forecast an upside target. And the way that I did that is I took the last rally beginning at 1680, which we know is a key and important number, up to this top here at approximately 1825, and then we go down to this double bottom to begin our Fibonacci extension, which will show us different areas in which it is logical to assume that gold could go to. I think the first level of interest is a very interesting one because it matches up with the 38.2% fib retracement. That comes in at 1795.60, and of course the 1.23% extension comes in at 1800. It is an important century mark. It does have a close association to where we could see gold go to, and then the upper level comes in at around $1,821.20, and that matches rather eloquently to this top that we saw in the middle of August. And that is truly where I believe we could see gold go to. It might not be in a straight parabolic line up. It might be a series of peaks and valleys, but nonetheless, we have been under so much pressure over the year as we've seen gold decline 22%, that the fact that we would get about 38% back of that drop is not unrealistic by any means. And we certainly can say that gold is absolutely oversold. If we send out the trade alert, it will go out via email as well as SMS text message, and it will go out before the conclusion of the FOMC meeting, before the statement is released, and before Chairman Powell's press conference. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.